Good.
Hey, good morning, everybody. Thank you so much for taking the time to be here today. We are really excited to have Ruzbeh and Homayar here to speak today and educate us on commercial real estate. We ask that everybody just go ahead and mute yourselves to make sure that there's no background noise while they're talking so everyone can just hear properly. I'm going to go ahead and share my screen and we're going to get started. Okay, give me 1 second. Sorry, I don't know why it's not letting me open it. Technical difficulty, give me 1 second. Okay, great, I'm so sorry. Okay, so here we are today. We have Creation Capital here, which is Homayar and Ruzbeh. So let's go ahead and do a little introduction. These are two amazing people who are very educated and well-versed in commercial real estate and have amazing resumes. Homayar has been a serial entrepreneur since 1991. He has been a real estate investor since 2018. He successfully launched and built technology, health, and wellness businesses in India and America. His analytical, methodical, and resourceful approach to problem solving, which helps him, in everything that he does on a daily basis with his work. And he has a great ability to motivate the people that are around him. He holds a bachelor's degree in accounting and statistics, and he's held various leadership positions in community nonprofit organizations. We also have Ruzbeh here, who is an experienced and accomplished financial executive. He has invested in real estate since about 2018 as well. He has worked for many leading global companies and is proven in managing financial operations. Ruzbeh is a CPA. He's also a certified internal auditor. He has held leadership positions at various professional and nonprofit organizations, the SEC Professionals Group, and a current board member at Project Access. They both live in Orange County, and we're excited to have them here.
Thank you for having us.
So this is a disclaimer that legally needs to be put up here today. This is specifically for educational purposes, and we just give you 30 minutes, sorry, not 30 minutes, 30 seconds or so to just go ahead and please read this. Okay, wonderful. If anybody else needs to read this, we're happy to share it with you later as well. Oh, sorry, before we get started, I just want to say if anybody has any questions during this presentation, just go ahead and type it in the chat, and then we will try to get to them as we are going through this, and then we will go ahead and get to it. Thank you so much.
Hi, everyone. This is Homayar, and thank you for taking the time on a Sunday to attend this webinar and showing your support to us. It means a lot. So I'll dive into this right away, that your ability to do things that matter to you the most starts with your mindset. And I can share that with an example of mine, that back in 2015, 2016, I used to get emails about syndication and investing in apartments and all that. And I used to just, sideline them that, okay, this is too good to be true. But I continued to kind of read about it and, kept knowing about it. So at some point, this person who used to contact me all the time, he says, I'm doing a course. And if you'd like to learn something about how we do this, why don't you do it? I mean, it's $800, and the most that would happen is that you won't learn anything from it or not use it, and you have just $800 to kind of risk. So I said, okay, I'm interested in real estate, so let me go and attend that course. So back in early 2018, I went there, I did that course, and that opened up my horizon of my, the way I thought and everything. that how people buy commercial real estate. For me, before that, buying real estate was buying a house or a condo and then renting it or flipping it. That were my choices, and that's what I knew. But once I learned about it and changed my mindset from knowing it all to learning, that kind of changed everything for me. And at that time, I realized that every commercial real estate in the United States, right from Empire State Building to an apartment complex that you live in, most of them are acquired and managed on this model of syndication. So it kind of resonated with me, and we started to explore that. And then Ruzbeh and I kind of decided to work together, and that's how we created this and started investing in real estate. So that's one of the main reasons people fall back in doing anything is the mindset. And I would like to emphasize that the learning mindset and trying to know things which you don't know opens up various horizons for you, which you don't even know exist. So the second one here is health. So if you want to do things that matter to you most, you need to take care of your health. And that affects your ability to do stuff. And the other two things are cash flow and wealth. So cash flow is the income that you generate on a regular basis. And then from what you save, you create wealth over a period of time. So these two things are something that you can control, have control by, learning and investing and, working towards it. And since we are kind of talking about finances and, educating people on how to invest, we'll talk more about the cash flow and the wealth in the following slides. So what, again, our ability to generate higher cash flow and long-term wealth, there are various factors that depend on that. So one is the time that we have. So if you're a busy professional, you have a very demanding job or business, you don't have the time to evaluate all the different sources or avenues to invest your savings, your money that makes you the best return. So one is a time constraint. Second is risk and reward. So that's very important. Like one end of the spectrum is, say, for example, speculative stocks. You invest in a speculative stock, your money could double, but the risk is tremendous. So, and on the other end of the spectrum is a CD, where there is very little risk, but you hardly get 0.5% return annually. So depending on how your personality is, you need to evaluate what risk are you willing to take and for what reward. So that's something that we have to constantly go over, and it's very dynamic. At each age level there is a different balance, and we need to kind of closely monitor. The other thing is that we generate cash flow, but at the same time, due to the high taxes, we kind of give away most of it to Uncle Sam. I should not say most of it, but a substantial chunk of it to Uncle Sam. And so saving on taxes also, on a long-term basis, adds up to your savings. And, for wealth creation, this is one strategy that everyone should look for, that how to save on taxes so that, you can get more bang for your buck. That's very important. People normally ignore it. People think that, I saved this much, I got this much return, and don't worry on the taxes. But taxes are a big thing, and everyone should have proper consideration for that in their investment strategy. And then the last is inflation. So we're right now talking about high inflation, and everything, price is going up. So that is kind of the thing right now, and over a period of time, that has been the case. Inflation has always been there, but right now we are seeing a higher percentage of inflation, and that's going to stay for a while. So here are just some examples on how these things, taxes, inflation, and savings, affect your income or your your nest egg. So we have taxes, there are reductions in individual taxes that might expire in 2025. So we need to kind of go over with that, what are the new changes happening and how do we adjust to that, because we have to adjust ourselves with what the new tax law is. Inflation is rampant right now and it's going to stay that way. There's a very good example here that $100 in 1930 were like $3.87 in 2019. And looking at the inflation right now, I don't know what that would be in 2021. It would be like even less than what it was in 2019. And then the savings that we have, that's very essential to build your nest egg. So on an average, these were the savings averages that each age group had in the US. So if you see the age group 65 to 69, on an average, had about $206,000 in their savings, which is, I don't think, enough, looking at the life expectancy, enough to carry people through their golden years. So if you start thinking about this at a younger age, kind of helps so that, when you get to it, you are prepared and you know what you're getting into and you know how secure your position is in your golden years. So these are the things to consider. So looking at everything and our inclination to invest in real estate, we think that if you want a risk adjusted, so as we talked about risk reward, if you want a risk adjusted stable cash flow on a long-term basis to create generational wealth, our solution is to acquire and manage commercial real estate in the United States, and that's what we do. So we're going to talk about how do we do things, or how can you evaluate an investment opportunity. So we'll educate and give you tools to kind of evaluate an investment opportunity so that you can make a decision and make an informed decision on what your investment could look like. So we'll start with what is commercial real estate. So commercial real estate falls, these four categories or five categories fall in commercial real estate. One is retail, office, industrial, hospitality, that's hotels, Airbnb, resorts, that kind of, and multifamily is apartment complexes. Now, between 1 to 4 units is single family. It's not considered commercial real estate. So if you own a fourplex, that's still regarded as a single family property and not a multifamily or an apartment, and it's not commercial real estate. So each asset class, each one is an asset class, and they all have different kinds of tenants and different kinds of income generation. So multifamily, basically, you have tenants, you rent out apartments, they are short leases, like month to month up to a year, and then you get rents from tenants. Hospitality is people pay for your room on a per night basis. And in these three, industrial, office, and retail, you kind of lease out for a long-term basis. So your leases are generally longer. And there is a specific kind of lease in these three, retail, office, and industrial, called the net lease, which we feel after a lot of evaluation is the safest way to invest in commercial real estate and the least risk that's there in commercial real estate. So moving forward, we'll talk about how to invest in commercial real estate, which fall under the net lease category. So what is net lease? You might have heard that it's a triple net, or, like retail properties or, offices or industrial warehouses, they go as triple net properties. So triple net, each N signifies an expense. So N1 is property taxes that you pay. The second N is for insurance that you pay for the building. And third N is for maintenance and upkeep. So if someone says that, I did a double net lease, so it could be two of these three. If it's a triple net, it's all the three. And in this structure, these expenses and the responsibility falls onto the tenant, and they can write them off as business expenses. And it's less hassle for the landlord to manage and upkeep these buildings. So it's more of a partnership wherein the tenant is also responsible in maintaining the property. So kind of they want low maintenance, so they'll take care of your property, as well as you get less headache in managing these properties. And your expenses, these are the main three expenses that are covered by the tenant. So we feel it's a very safe bet, and this kind of lease is highly prevalent in the three asset classes that we went over: retail, industrial, and office. So these are some examples of what a net lease property could be. So the net lease could be two types of properties. One is a multiple tenant net lease, which is a strip mall or strip center or regional strip center, where you see all these anchor stores like a grocery store, and then you have other shops and some other small anchor that kind of goes with it. And then there's a single tenant net lease, which is something like McDonald's or a CVS or a Family Dollar or something of that sort, that's by itself. The building is on a separate piece of land by itself, and it's not combined with other similar retail properties or industrial properties. So these are some examples like dollar stores or McDonald's, Starbucks. Most of these large retail or industrial, in the sense like Amazon warehouses or a Kroger or Ralph's grocery store, Whole Foods, DaVita, those kind of medical offices, most of them go with a net lease structure as their lease. So these are just an example of what kind of properties you would see if you invest in a net lease deal. So why net lease real estate? Because it's relatively low risk and it produces income on a regular basis. So most of these net lease, so example, if you buy a Dollar General or a McDonald's, most of the leases are guaranteed by the corporation. And so they are investment grade. I mean, if you, depending on who the tenant is, but you at least have a corporate guarantee wherein they have something to lose if they leave the property. So the rent is backed by corporate guarantee, and they're long leases. The leases go up to like 30 years, sometimes 50 years, with say 15 years base lease plus extensions, and each extension the rents go up. So you have a stable income growth as you go over. And so it basically adjusts with inflation. So you have something that kind of adjusts with inflation. So you don't have to worry about your money not working or, increasing at a lower rate than inflation. And then, as we said, commercial real estate has a lot of tax savings. So this is, I mean, you will not find these kind of tax savings in any other asset class or any other investment that you have in commercial real estate. So we'll discuss those tax saving strategies as well as we go through. And it's, as we said, triple net, mostly, the expenses and all the responsibilities of the tenant. So that way it's easier to manage and it's low maintenance because they don't want to kind of spend more on that. So they try to maintain the property well. And again, as in all real estate, it builds equity during your whole period. Your tenant pays for your equity, and over time, kind of you pay down your debt, or your asset as it appreciates, you build equity on that. So how to evaluate, like if someone brings you a deal that, okay, this is a McDonald's or this is a XYZ, how do you evaluate a deal? How do you invest your money into that deal? So this is how we do it. So I'm just sharing that with you. And if you are investing in a deal with anyone, you need to kind of talk about these points wherein, how do you evaluate a deal? So first is we look for is a neighborhood and the location. Location is most important in retail or any kind of real estate. Not residential. Residential is different. But if you're investing in commercial real estate, location is key, because if people don't come to your location, you may have the best business, but it doesn't mean anything. So depending on what kind of businesses, so if it's a Dollar General, we look for that kind of demographics, that kind of neighborhood. And if it's a McDonald's or like a Whole Foods, that will have a different demographic base. So every real estate has a different kind of demographic base, but that's what we look for is what kind of neighborhood is it? How many households are around it? How many people live around it? Like usually we want that there should be at least 50,000 people living in the 5-mile radius. So that's the bare minimum for us to even consider buying a deal. And then what's the employment trend? Is the population diminishing or population increasing in that area? So we look at that as well. And then, the demographics should, as I said earlier, it should match what the tenant is. So each kind of business, so if it's a Starbucks, it will open up in an area where the demographics are medium to high end, a high income level. Dollar stores are usually in low to medium end of neighborhoods. So you have to see that. And then VPD, that's vehicles per day. That's very important. That if a business is on that road, how many vehicles are passing through that road? Our criteria is the minimum of 10,000 vehicles a day, or ideally it should be 15,000 plus, but we will consider anything about 10,000. So then comes to how, after we kind of decide on what do these, because these things you can't change. You can change the tenant could go and come, new tenants could come, but these location and demographics you can't change. So that is very critical. And then after that, we go on to the tenant, that who the tenant is. Is it an investment grade tenant? Is it a corporate guarantee? How many stores do they have? What kind of balance sheet do they have? And how is their performance? How is that particular location performing? Because that shows their ability to kind of continue leasing that place for a long period. So we kind of look at that. And once those things are confirmed, then we look at the lease terms, that, okay, is there any early termination clause? Is there any performance related clause? What are the guarantees? What is the duration of the lease? We look for a minimum of 3 to 5 years on the lease. And then plus we want to see extensions there with rent increases. That's what we look for. And so that's how we evaluate the location and where to kind of buy a real estate property. And then we get into these financials.
Thanks, Homayar. So once we go through the geographical and other qualitative variables of an asset, only after that we go into the numerical factors, right? And we primarily focus on 3 things from a numerical or a return perspective, that is cap rate, the net operating income, and the cash on cash return. And I will talk about that further in the next slide. Once we evaluate those, and we also look at what are the different tax savings, right? I mean, depending on the asset, we perform a cost segregation study and how much benefit can we get out of those tax savings. And we also evaluate where the property is located, if it's located in a tax-free state like Texas or Florida, or if it's located in a other tax jurisdiction, what could be the impact on our returns from those tax savings or taxation from those jurisdictions. And then lastly, we also evaluate our exit strategy, right? I mean, if the lease is, the remaining lease on this term is for 7 years, are we going to hold it for 7 years? Are we going to do an early renewal, or what other things are we look at CoStar reports when we evaluate property to understand what are the cap rates going to do in future, right? And if we have a plan B, whether we think, will this tenant continue, or are we going to have to re-tenant it? So these are all the things that we have on this slide that we take part of it as part of our underwriting process or our financial modeling that we do on our properties before we make an investment decision. So as I said about the numbers, I think there are three things that we primarily evaluate on are the net operating income, right? For any business, I mean, you need to understand what operating cash flow or operating income that business generates. And not only us as investors, I think even the banks, this is the most important thing for the banks that they look at, because when we borrow against that property, the bank is not only looking at this property as a real estate asset, but it's also looking at it as a business. And they want to understand whether the business generates enough cash flow to be able to service their debt requirements. So not only, so for us, we look at the net operating income. That's the first thing. The next thing we look at is the cap rate, right? The cap rate in a real estate is very important, right? Normally, the higher the cap rate, the better you think about the property. But I think that's all relative, right? A 10% cap rate is not necessarily relative, is better than a 5% cap rate property, right? I mean, if you look at an example of properties in Manhattan or Silicon Valley, I mean, they tend to have very low cap rates because those are really premium properties, right? So when you have a property, let's say if you're looking at a property in Silicon Valley where the cap rate is 4%, and this property that we are looking at is offering us a 5% cap rate, then we are getting a good deal because we are getting a better than market cap rate. Or if you're looking at property in areas that are going through some kind of gentrification, and over there, the cap rates tend to be high because they are still going through an improvement process. And if it's even if it's a 10% cap rate going in that rate, if you're buying at 9 to 10, but you know that in future, the gentrification is really going to change the area and the cap rates are going to change, then these are all these things that we look at. And then lastly, I think we look at the cash on cash return, because for our investors, we want to make sure that we are making enough money, right? So what is the cash on cash return is, this property will generate a certain net operating income. And from that net operating income or cash flow, we will pay the bank mortgage amount or the bank's debt service that is required. And then after that, the remaining amount we will distribute to our investors. So for us, we want to make sure that the cash on cash, there is enough cash left after paying the bank mortgage and our expenses, that we are able to provide a good return to our investors. Next one, please. So how do we invest in this? How would you invest in a net lease property, right? I think there are three ways we can do it. One is we told you all the ways what you're required to. You can purchase and manage your own net lease property and go through everything that we are describing here and do it yourself and get all the returns and benefits for yourselves. But if you don't have time or energy or resources, the other way is maybe you can invest in a publicly traded REIT. There are lots of REITs that offer this type of investment opportunities. But the pros and cons of the REIT are that the REIT they are highly liquid. They go in tandem with the stock market. So if the stock market goes up, the value of the REIT may go up or go down, depending on what it is. Versus a private equity fund, your funds may not be that liquid, but at least they don't fluctuate according to the stock market, right? So you are not necessarily prone to the swings of your stock market. And then the last one is you can invest in a private equity fund that manages net lease properties, and the value of that property won't be fluctuating, at least on a daily or quarterly basis. So why private equity fund? So one is it's a passive investment for you. Like I said, we don't have to do anything. You put your money in and then let the managers manage the investments for you. You will get greater transparency in a private equity fund because you will be investing, you will be knowing the managers of that fund. For example, if you know me and Homayar, right, that's something that you guys know. If you have, so in case of, if you have any questions, you can pick up the phone and call the managers of those equity funds, right? If you invest in a REIT or if you invest in any other mutual fund, you won't know those people. So the only way you have to rely on is wait for the quarterly reports to come to get all the information. Like I said, you will be mitigating the risk of stock market by diversifying into an asset class that is not subject to fluctuations of the stock market. It takes relatively less time and effort for you to own an asset. All you have to do is, fill out some forms, be part of that equity fund, and then as the fund invest, your money is put to good use. You are able to get substantial tax savings, which I will share later with you guys what those tax savings normally are. And you get preferred return and a stable cash flow with asset appreciation in the private equity fund. So when you're looking for a fund, normally, what is it that you would look for to make sure that this fund is safe, sound, has all the information? I think, so there are 4 things that we would advise you to look for. One is the online. So when you go on the fund's website, do they have security and secure information login? Do they have all the information once you log in about their assets, their funds, their returns? If you're invested in that fund, do they have a dashboard that tells you how your money is doing, what is the return on investment, all in one snapshot? I think that's very key. The other thing is investor centric. Is the fund looking out for the best interest of the investors? Is the fund, if you invest in one fund, is that fund investing in only one type of asset? Are they investing in multiple types of asset? Are they giving you multiple opportunities to invest? Or is it just you put money once and it's all invested in one property, right? So I think, is the fund more investor centric where you get more diversity to invest and put your money to different uses with them? I think the other one, the third one is the most important, is co-investing, at least in my opinion, is the fund, are the managers of the fund investing their own money with your money in the fund, right? Because if they don't have a skin in the game, then, I think there is some risk there. So it's very important that they put their money where their mouth or, where their investments are. And I think the last one is security. So we want to make sure that the funds are compliant with SEC requirements. In our fund, we are compliant. We are compliant with SEC requirements. We do all the SEC required SEC filings as well as blue sky law filings in each state that we have for securities. Our lawyers do that for us, and so that's very important. And then I think the other thing, when you do this, is there a question? So we'll answer a question in 1 minute. Sorry, let me finish this slide, please. So
I think, sorry to interrupt. I was just going to say, I think if we hold all questions off until you guys are done, then we'll have a good chunk of time to kind of get into questions. So we're not maybe going back and forth and losing track of exactly what you guys are talking about.
Sounds good, Natasha.
Okay.
So, yeah, so I think we want to make sure that they are SEC compliant, and also in a fund, like, for example, Homayar and I we can do everything. We have full-time jobs, plus we do this, right? So, the process that we described to you is very laborious, and it's also very rigorous, right? So what we have is we have a team of professionals that we have assembled, right? And we work with that team to make sure that they help us. Our job, Homayar and my job, is to make sure that for our investors, we find the best deal and we provide the best return on the money, right? Other than that, the execution of the deal and to go through the entire due diligence, we need to have a good team in place. So you want to make sure that the fund that you're investing in, the managers have a good team in place. Who do they work with? Who are their advisors? Who are the professionals that they work with? I think that's very important. this is just an example of the service providers that we work with, our, our law firms, our lender broker partners, our inspectors. So these are all the professionals that we work with. Okay.
Okay. So thanks, Ruzbeh. So now, how do you invest in these, and who can invest in these kind of offerings? So back in 2013, the Jobs Act was revised, and they made an exception in Regulation D, Rule 506. SEC made an exception, and they put in these two rules, 506C and 506B, wherein if you are raising money for your own project, in the sense your own business, your own real estate offering, then you can raise it through these two vehicles, that is 506B and 506C. So there are two categories of investors that SEC allows to invest in these kind of funds. The first one is the accredited investor, and that is the kind of investor that used to get the opportunity to invest in these kind of assets prior to 2013 as well, and that was a select group of investors. So the accredited investors, they updated some regulations, and now accredited investor is someone who has $1 million in net worth, excluding their primary residence, or $200,000 as an annual income if they're filing single, and if they're filing joint, it's $300,000. So that qualifies as an accredited investor. And an accredited investor can invest in both kind of offerings, a 506C or a 506B. There is no restriction for them as long as they have a third-party verification done about their classification as an accredited investor. Now, the second type of investor is the sophisticated investor, that the SEC calls them sophisticated investors, who do not have 1 million in net worth, or they don't make 200,000, but they have the financial whereabout wherein they make their investment decisions, and they are in sync with what happens not in the financial world, but they know what investments are, and they have gone through different kind of investments, and they have some kind of financial literacy, not like being an investment banker or anything, but your personal finances, if you can invest, that is kind of called a sophisticated investor. There is no verification, third-party verification. So it's people who know, who the managers know and kind of verify that, yes, you have some kind of financial literacy and you are able to invest and make decisions about for your money. That kind of an investor is a sophisticated investor. And so sophisticated investor can only invest in a 506B fund. You cannot invest in a 506C offering. And in a 506B offering, you can only 35 sophisticated investors can invest. You can't go more than that. So these are SEC guidelines, and each investor has to be kind of, we talk to each investor and, find out what their goals are and what they want. And then, you can invest or you can't invest. So these are the two, since after 2013, you can invest using this regulation 506C and 506B.
All right, so I'll take you to a typical fund structure. Normally, funds could be structured in different ways, but this is a typical example of how a fund is structured. So normally there are at least 3 types of LLCs or entities involved, right? So we have the 3 types of entities are, one is an investment entity, where all the monies are held, or the investors put their money, the general partners, the limited partners. The second one is the property LLCs, where the properties are held. And then the third one is a manager LLC, where the managers do all the work, and there is different types of, for credit. They are basically, it's an enhancer entity. So if you look at this brown colored or orange colored LLC here, that is an investment entity, right? So all the members and the limited partners, investors, will be investing their money in this LLC. Then this LLC, the brown orange LLC, will be investing in each property LLC. So here you see it, one example is it holds or owns the Family Dollar LLC. Then if you buy another asset in that fund, then there will be another single purpose LLC that will be created to own that LLC. And then on the right here, the blue one, the Creation Capital LLC, that is an example of a manager LLC. That manager LLC basically manages the brown orange LLC, which is the investment LLC, right? So the manager LLC, what it does is it works for getting credit from the bank. It does money raising from investors. It does property management. So we have created this different LLCs for one is for tax benefit reasons, and second is also to provide some sort of protection or shield from any kind of lawsuit or litigation. So I mean, that's a typical structure of how funds are structured, but depending on other things, there could also be potentially more LLCs involved. But this is a more simple structure how it can be formed. One, please. So in a fund, what are the typical returns, right? I mean, that's the $1 million question. I mean, you invest money, you go through all this, but at the end of the day, what is a good return that you're expecting? So there are three types of returns that you can get from investing in a private equity fund. The first one is a preferred return, right? So you invest in a property, the property pays, let's say, a rent of $10,000 a month to your fund. The fund pays $5,000 in mortgage and other expenses on a monthly basis that's required to service the property. Now, the remaining $5,000 that's remained is typically distributed to the investors in the fund. That is called a preferred return, right? And that preferred return could be, it's normally in single digits, depends what it is, right? So that's a preferred return. And that preferred return is generally distributed on a monthly or a quarterly basis, depending on how the fund distributes its preferred returns. The next one is a share in profits, right? So when you acquire a property, net lease property, let's say you acquired that net lease property for $1 million today. Normally you have a whole period of anywhere from 3, 5, 7 years, depending on what the fund requires you to hold the property for. At the end of that whole period, normally when the property is sold or refinanced, depending on what the exit strategy is, let's say the value of the property has gone up, let's say to 1.3 million, right? Now, normally, so that 300,000 that is additional over the cost, that is a share in profit, that is profit. And that share of profit is distributed to the investors, right? Your profit will be more because you've also paid down the loan in that 3 or 5 years. So actually it will be more than that. So that's your share of profit. So that's the other thing that you receive. And then the third one is tax savings. So what are the typical tax savings that you get from a commercial real estate? So in commercial real estate, what we do is we perform something called a cost segregation study. And a cost segregation study normally involves taking the property and breaking it down into different components. And because normally on a residential property, when you invest in a residential, you depreciate that property over 27.5 years. That's the standard IRS allows you. But in commercial real estate, you can actually take the property and break it down into different components like the building structure, the HVAC, the plumbing, the electrical, all these different things, and you can assign shorter lives to those each components. And what happens as a result of that is you can accelerate a lot of depreciation in the front. So even though the property may have a life of, let's say, 30 years, you can actually depreciate almost 50% of the property in the first 5 to 7 years because of this cost seg study that IRS allows on commercial real estate. Not only that, in addition to that, there is also something called a bonus depreciation that's allowed, right? So you can take bonus depreciation on commercial properties. So what this does is all these additional depreciation, plus there could be certain state tax benefits depending on different states, plus you get a business income deduction on your LLCs. All these things, what they do is especially the accelerated depreciation, bonus depreciation, it creates a paper loss for you, right? So even though you technically are not having any loss, it's just depreciation, but because it creates a paper loss, the preferred return that you are receiving on a monthly basis, that preferred return is not taxed. So for the first 3, 4, 5 years until that property is sold, because the depreciation is so huge, it creates a paper loss. The returns that you are receiving, so let's say from a property, if you're receiving a 5% return, that 5% basically is tax-free for you. So as a retiree, if you're in a 20% tax bracket, which is say your federal plus state tax bracket, now you're earning that 5% tax-free, right? So effectively you're earning almost like 6 or 7% return. Or if you're a busy professional and you're in a 30, 35% tax bracket, you are effectively earning a 7, 8% return by getting a 5%, which is by creating the paper loss that we do. So these are the typical returns that we do. And the best part, like I said, is you can almost write off 50 to 70% of that depreciation in the first 4 to 5 years. Of course, that has some implication later. There is a depreciation recapture tax. I don't want to go into all those details now, but there are different. So when we exit the property later, there are other things that we have discussed with our tax advisors, how we can avoid that depreciation recapture or capital gains tax on the back end also by either rolling it into a different fund or doing some other tax strategies like swap or doing a Delaware statutory trust or doing a 1031 exchange. So we have considered all those discussions, which we will discuss when the time is right with our investors. So yeah.
So here's a case study that we just go over what we discussed. So this is a family dollar that we acquired in June of 2021. And as we described that, we look for the demographics, the vehicle count. If you see here, it's on the main artery, and it's the intersection where it's on is an intersection where there are 42,000 vehicles intersecting every day. So this is like a very high volume artery of Memphis. And that's the reason we kind of went with this. The demographics of this also, if you see in the 5-mile radius, instead of 50,000, they have 125,000 people, which kind of works very well, because the more houses, more households you have around your business, the more likelihood that the tenant will stay there for a longer period. And the demographics also are ideal because if you see the income level, the household income is ideal for a dollar store. And if you see in such neighborhoods, I have driven across these kind of neighborhoods, and dollar store is the go-to store in that neighborhood. So we basically look for these kind of, conditions wherein that the tenant is going to stay for a longer time. Then we acquired this at a higher than market cap, as Ruzbeh discussed, that if it's a 6 cap and you buy it at a 6.5 cap, that means you are kind of getting a good deal. If it's a 6 cap, you buy it at a 5.5 cap, you kind of are paying more for that asset. So we acquired it higher than market cap. And then we got a low fixed rate debt, because right now the debt you can get is at a very low fixed rate. So we went for that. And then strong source sales. So we look for how the tenant is performing. So this is one of the top 25 Family Dollar is part of Dollar Tree. So they are Dollar Tree, Family Dollar is the same company. So it comes under the top 25 performing stores of Dollar Tree in the country. And so that kind of, you are kind of assured, not assured, but you know to the best extent you can that, you know, this tenant is going to stay for a long period of time. And then in retail, there's something like sales to rent ratio or rent to sales ratio. So if, say, you're paying $100,000 in rent annually and your sales are 2 million, then you're paying like a, you know, 5%, kind of a 5% sales to rent ratio. And anything below 10% is a very good ratio in retail. So you kind of have to evaluate that because if you're a business owner and you're paying low rent and you're making high sales, that's the location you want to be. So we look for that, and then we look for how many renewal options are there after, you know, the main lease ends. And because each renewal option you get a rent bump of 5 to 10%, so that's adding to your income. So we look for that, and so this has like 3 5-year options after the first initial lease ends. So that's kind of another 15 years to go after this basic period ends. So this is a kind of deal that we, and then we also look for other businesses around it. Like you see, there's a McDonald's there, there's a KFC there. So we look for those kind of businesses nearby, that how, you know, this area is. And this also is a very big tourist attraction because Graceland, the Elvis, Graceland is like less than 2 miles from here. So that brings in a lot of tourists to this area as well. So you will look for all those things before acquiring, and you should also ask those kind of questions when you're evaluating a deal to invest in. So if you invest in a typical fund, what are the steps that you'll need to kind of take? So first and foremost is you'll have to join the investor network. And that is basically nothing, that's not a commitment to invest or obligation to invest. And legally, you're not bound to invest if you join an investor network. It's just the first step wherein you can get information of the fund, what the fund makes, what are your returns, and all that. So by doing that, all you are doing is showing interest that you want to know what the fund does, and you are in no way obligated to invest. And after that, you create a secure portal. If the fund has a secure portal, which you should always look for, because if you don't have some kind of secure portal and they're sending reports on an Excel sheet, that's kind of a little primitive and not secure as well. So you should kind of make sure that they have an investor portal. You create an account, and then you see the investment. What do they have to offer? What kind of returns they have to offer? What kind of fees are they taking? So once you evaluate all that, and if you like what you see, then you go into, you know, downloading the private placement, because this is a private placement. It is not public placement shares. This is a private placement opportunity. So you download or go over the private placement memorandum, the PPM, and see how the fund is being handled. And once you are convinced that, yes, this is something that you want to invest in, then you get qualified, you fill in the subscription booklet, and that's where you qualify your status as an accredited or a sophisticated investor. And, you know, depending on where you fall, you get qualified and then invest online. And then all the distributions that you get, if it's a secure portal, you also get all your distributions online as well. So this is a normal process. It doesn't take too long. I mean, you do have to read stuff and you do have to understand stuff. But once you do this, the PPM and the qualification, then you can, you know, continuously invest if you choose to, or just invest one time and you are invested in all the assets of that fund automatically. So I would like to thank you all for joining this webinar. And if you need to, because there are a lot more things to discuss and, you know, to know, if you are interested, this is our contact information. Please feel free to reach out to us, or you can, you know, type your email or phone number if you want us to contact you in the chat. But I mean, This is up to you. Please feel free. And this is for education purposes. Even if you have any questions, feel free. You're not obligated to invest in any way. Just feel free to ask any questions that you have right now or later. And I would like to end with this saying that financial independence is all about having more choices. So the more choices you know about, the more informed you are in making decisions about your financial future. Thank you, and let's open it up for questions.
So I've just put my cell phone number in the chat in case you guys have any questions. And if you guys, more personal questions, this is, we are doing an educational thing, so we won't be able to answer specific things about our fund. But if you guys want to contact us, please feel free to contact us at, on my cell here or Homayar cell. Okay. Natasha, should we start taking the questions from the first one?
Yes, absolutely. However you guys feel fit to answer whatever questions you're comfortable with, please, definitely.
So what is the typical asset mix in, say, a 5 million? So the asset mix depends on the type of fund you're investing in. So if you're investing in a just blind pool fund which doesn't say anything, then it could be any asset mix from the 5 that we showed you, multifamily, retail, industrial. But if it says specific to some one asset class, then it will be that particular asset class, but different kinds of assets in that particular asset class. So if you are investing in a retail or a net lease fund, say for example, it will be various net lease assets purchased in that fund, and the typical return of that fund will be the same for everyone who invests.
Yeah.
Does that answer the question?
Yeah, and I would add to that. I think when you say $5 million investment, I don't know if you're referring to the 5 million as equity, so debt be added to that, or you're talking about 5 million total investment, right? Because $5 million, I mean, you can buy maybe smaller net lease properties, or you can buy maybe smaller apartments. But if you're talking about 5 million of equity plus debt on it, now you can put more money to use in more different assets. So I think it really depends on the asset class, location where you're buying. So there's no standard answer to what an asset mix could be. It could be, it all depends on location and asset class. The next question is, what is the minimum investment? I think that depends on each fund. Each fund has different criteria. We have seen in a typical real estate syndication, typical investments are 50,000 onwards. There could be some funds that even allow as low as 25,000. And then there are some funds which require minimum 100,000. It also depends. Some funds will only take accredited investors. Some funds will allow accredited as well as sophisticated investors. So it really depends on fund to fund.
Okay, on the opportunity zones, yes, opportunity zones. I worked on opportunity zones, and basically there are areas where the government has kind of designated them as gentrifying neighborhoods. And if you invest in those funds, in those zones, then you can defer your capital gains, long-term capital gains. You can defer up to a period of 10 years. And then when you pay after that time frame, it lowers your capital gains by 15% that you pay. But the thing is that anything you make from that particular property, from that opportunity zone property, is all tax-free. So you don't get charged any capital gains from your income or appreciation from the opportunity zone property. Plus you get a deferral on your previous capital gains that you got the investment in. So it's kind of the ideal time to invest in opportunity zone was around 2019, but any time is good. But remember that those are properties that are in gentrifying neighborhoods. So there is a greater amount of risk involved there, but the returns are much higher, and you get certain tax advantages if you invest.
Yeah. So Jongir, I would just add that for opportunity zones. There could be funds which are specifically for investing in opportunity zones, or there could be funds which may invest in regular assets along with opportunity zones too. So it really depends again on fund to fund what their focus is. And we personally do a mix of both. If a property comes which is in an opportunity zone, we will look at it, but we don't necessarily focus just on opportunity zones also. When do you want to share the name of the course that inspired you?
What?
That's the next question. What's the name of the real estate course that inspired you to get into this business?
Oh, okay.
I think it was
so there's this syndicator whose name is Neil Baba, and he's in Northern California in Silicon Valley, and he started to call me when he was quite new. Right now, he owns around 500 million worth of real estate. And so, I mean, he's kind of my mentor, and we kind of communicate on a regular.
His last name is Baba, but he's not a Parsi.
Yeah, he's not a Parsi, but he's from Bombay. His name is Neil Baba. Yeah. So,
next question is, can you roll over an IRA account into the fund? Yes, you can. It can be a normal IRA account, a traditional IRA. You will have to convert your traditional IRA or a Roth into something called a self-directed IRA. And we can guide you with certain companies that we work with. Once it becomes a self-directed IRA, that self-directed IRA can be rolled into, you can invest it into a private equity fund, anything you can do with that, because then it becomes an open checkbook. So, or even if you're a professional and if from your own business, if you have a solo 401k, even that can be invested into a private equity real estate fund. Okay. Do tenants share info regarding their gross income? Yes, they do.
Yeah, in some cases they do, in some cases they don't. So we rely on the foot traffic. So we have certain software that kind of give us what the foot traffic is, and depending on that. So as you said, we work with those partners. So it depends on what kind of partners you work with, and they get us those kind of information. If the location doesn't report sales, then there are other ways of finding that what kind of sales that location could be doing. But yes, most of them report sales on an annual basis.
The next one is, do you also provide expertise services to individuals looking to purchase or invest in commercial properties? You mean we consult with? Yes, we will help you. If you need to, have any questions, feel free to come and ask us. We will definitely help you, for sure. How can we get login credentials to get more information about your fund? So you can go to our website, creationcap.com.
I'll put the link here.
Yeah, the link.
If you're interested, just click on the link. There is a short form that you have to fill. Again, there is no obligation to invest. You just fill in the form, and then you'll get an invitation to, create a login and password.
Right, but that's required. It's an SEC requirement that we have to fulfill, and that's why you are required to be join our fund first or be part of our portal before we can answer more specific questions. So, and there is no personal information requested. It is just basically your name, number, are you willing to make a soft commitment? That's all we are asking. So once you do that, then we can discuss more specifics, or you can find information about our property that we have in our fund. Okay, next one, yes, total investment. What is the lower end in the single digit total investment? Spectrum. Not sure, this person vision of health, I'm not sure I'm understanding your question. If you can speak up, maybe we can have a discussion about this, please. So $5 million total investment.
Yeah, okay. My name is Sam Villamora, and you must excuse me for that horrible title that is coming up. It's a glitch that is in the Zoom. Anyway, I'll get on to this thing. What you said was that there was a single digit of spectrum. You mentioned the returns in single digits, and I want to know what that lower end could be. In other words, is it 4%, 4%?
That is specific to a fund, and for that you'll have to join. For us to share any specific information as per SEC, we can only share that information with someone who is part of the investor. Unfortunately, I mean, we want to, but we are kind of regulated with that, and we can't share specific information. But it could be anywhere from, you know, it could depends like 3%, 10%, 5%. It could be anything, but it again depends on the fund that you're investing in, and you'll need to take the first step to joining the network to know specifics of a particular fund. Unfortunately, that's the step you'll have to take.
Okay, I understand that, but thank you for your information.
So Samuel, I think the way it works is you get a normal single-digit return in the, you know, on a preferred basis, right? And as you said, it can depend on fund to fund. Some funds may provide low single digits, some funds may provide high single digits. It all depends. And then, you know, your overall total return may also differ, right? Some funds, depending on if they're more cash flowing, they may give you more preferred returns. And then, you know, your overall return may be, you know, so your share in profit may be lower later, or you may get lower returns in the beginning and you may have a higher share. And it's all depends on how the funds are structured. So, you know, there's no standard answer that we can give you right now, but we'll be happy to discuss our specifics once you're in our portal.
Okay, I understand that. So basically what you're saying is that it is a strategy of something kind of the equivalent of mutual funds, if you will, in also in this real estate investment.
Yes, it is.
Just giving you an analogy, so to speak, broadly speaking.
Absolutely.
Okay.
You can analogize to a mutual fund, but you know, there are, like I said, the taxation and structures and all are different from a mutual fund. But yes, to a layman, it is very similar to a mutual fund or a REIT. Yes.
Thank you, sir.
Sure.
But here in this fund, you also share the profits, right? So it's not just the income that you receive, but you also receive a share in profits. So you're investing in equity.
I think the next question is, what is your average preferred return, hold period, target equity multiple? Again, sorry, Mr. Adibili Moria, I can't share specifics about our fund, but I can give you an idea. I mean, the average preferred return again could be, normally we have seen them in single digits, right? I mean, anywhere from, I would say, most operators that we know, you know, pay anywhere from 5 to 9%, depending on what asset class they invest in, what, you know, they are doing, which location specifically they are invested in. The whole period is minimum 3 to 5 years. Again, for most funds that we know, could be as high as up to 10 years. So it really depends. So you have to make sure when you invest in this kind of funds that your funds will not be liquid for that period. And the target equity multiple, it could be all over. It could really depend on the asset and location. But if you want to specifically know answers to these questions for our fund, you will have to be part of our portal.
No, I understand. You answered my question with the previous answers. So that's what I will do is sign up for the portal and hopefully get some answers.
I have posted the link there in the chat. So if you just click there, it'll take you to that. And then just, you'll get an email to kind of create a login and password. And then you can check all the fund information there.
Very good. Thank you.
Thank you, Mr. Billamoria. Okay, the next one is with the
headquarters of major companies like Apple, Tesla. Yes, Austin is a great market to be in. But as I said, you know, so is Manhattan, so is LA, all are great markets to be in. It's at what price point you buy the asset at. But Austin has seen a lot of growth lately. And so the cap rates have compressed. That means the asset values have gone up. So if you are getting something higher than the market cap, so say Austin is a 5 market cap, and if you're getting something at 5.5, yes, it's a good opportunity to buy in that market. But if you're, you know, paying up to be in Austin, that okay, even though it's 5 and I'm paying 4.5 just because everyone is moving to Austin and I should move, then it's not a great deal. So it depends on your investment thesis, what you want out of it. You want future appreciation and you don't want cash flow, then you can, you know, go for lower cap rate markets. If you want cash flow and appreciation, then you kind of go for such markets. Houston is a good market. Dallas is a good market, as we know, but they are all kind of booming right now. So you have to be careful on what you pay for that being in that market. So that's very important.
Yeah. I would just add to that, Rustam, that we do evaluate properties in the Sun Belt, like anywhere from Texas to Florida, which is booming, you know, Alabama, Tennessee, all those. I mean, right now, everything over there is hot and, you know, just up. So, but we do look at properties in all over those places. Yeah. Okay. Next one, invest as an individual. Is that okay? Who determines if someone is an accredited investor? How can I start to get to be an accredited investor? Okay. So yes, you can invest as an individual. Absolutely. You know, you can invest as an individual. You can invest, like I said, through your IRA 401ks. You can invest through your trust. However, you know, you can have your own LLC, and an LLC can invest in also equity funds. So you can invest through different sources. Who determines accredited? Like Homayar said, these are already defined, you know, by SEC, what an accredited investor is. There is an income and a net worth definition. So if you meet those definitions required, then you are considered an accredited investor. And I mean, if you want to call us later, we'd be happy to discuss more specifics with you. And how can I start? I mean, again, like I said, it depends on your income. If you have that income or net worth, then you're already an accredited investor currently.
So if you can, there are third-party verification sites. You can just go online and you can type in accredited investor verification, and their third-party sites, they charge around $50 or so. So you can get it done that way. Your CPA can give you a letter saying that you are an accredited investor, and you know they know that they can vouch for that. So those are the two ways you can do it. Or you can join an investor network, and the fund that you're investing can help you determine that. So there are these ways to kind of get yourself accredited, if you are accredited or not.
Okay, the next one is from Jehan Lalkaka. Hi, Jehan. What percentage of property purchase value is typically financed with debt? Yes, typically it really depends on the property and the location, what the banks are willing to work. But in the retail sector, they go max up to 75 LTV, where depending on if it's a, you know, property in a not very good neighborhood or with low NOI, it depends on numericals also. Then the banks or the lenders could provide only 50% LTV or loan to value ratio, as they call it, right? So if your property is worth $1 million, they can only provide 500,000 worth of financing, and then you have to put up the remaining equity, or they can go up to 750 also. So in retail, it is capped at about 75%. In multifamily sector, they go up to even 80%. We have seen some even do 85. So it depends on different asset classes, you know, what the banks are willing to lend. But typically, they range anywhere from 80% depending on asset classes. And I would say most of the properties that we see or deal with are within 70 to 75% range. That's the sweet spot for most lenders.
And as we said earlier, the commercial real estate deals are also evaluated on an NOI basis. So it's not just purely as you're buying a home or buying a residential property. That only goes on comps. That's comparable values. So if the house next door to you is say 500,000, you will get something around that. But in commercial property, it's different. It's the asset where it is, plus it's the revenue it generates. So the banks also, and people buying and selling these assets also consider NOI as one of the main factors in buying a commercial. So NOI is important, plus where your real estate is. Combined, the banks and everyone kind of determine the value of the property.
The next one, from Farad, do we have a say in which funds we want to invest once we join the investor network? So I think that depends. If a fund is specific to one asset class or location, then it's like you've invested the money and that's what the money will be invested in, right? It's like when you join a mutual fund, you don't have a choice of what stocks the asset manager buys, right? So it's the same thing with funds. But depends. So let's say if an equity fund or an operator of a fund has two different funds, one is for retail or net lease and one is for multifamily, you can choose to invest in either one of them, right? But if they don't have the choice, if they just have one private equity fund that invest in anything, whatever they feel like is a good providing, then you don't have a choice in that, right? So it all depends on fund, how the fund is structured. And that's why we ask that you talk to the investor, understand what their fund does, understand what they invest in, make sure you're comfortable. And then that's how, because once you put your money in, it is invested in that fund for the life of their fund, which can be anywhere from 3, 5, 7 years. So that's what it is. Hope I answered your question. The next one is, what is a reasonable management expense ratio for such commercial real estate private equity funds, and how should we evaluate high versus low expense ratios? I think that it depends the property management. Again, it depends on what types of lease they enter it, right? If most of the leases are triple net, then the property management that you have to perform is very low. If many of these leases are double net, then there could be some property management or some expenses involved. Again, if you're investing in a multifamily fund requires very active property management because you have to deal with tenants on a daily, monthly basis. You have to make sure every time someone leaves. So that requires a very high property management. In case of retail or office or industrial, once a tenant is in, they are in for a long period, right? 5 years, 10 years. So there is not much required. So again, it depends on how the fund is structured. Your property management fees could be as low as 1-2% all the way up to 8-10%. So it really depends on each fund, property, location, what their structure is.
Are you bound by time frame, 5 years, 7 years? Can you roll over to a longer time frame? Yes, most of these funds are between 5 years is the ideal time frame or whole period, most of it, and depends on the market at that time. If we feel that it's worthwhile to kind of wait and sell it at 7 years or refinance after 7 years, it could go up to 10 years all the way. So it entirely depends on what time we feel that this will give the best returns to the investors and also us, because we also invest our money here. So we are also looking at what you are looking to get out of it, the best returns and stable cash flow over a longer period of time. But typically it's 5 years. It could go higher depending on market conditions.
Yeah. So I think Mr. Contractor, and I think next one, Kapadia's question is a similar one. I'll just add to that yes, once these private equity funds are more like private equity, right? Once you invest your money, it is illiquid for that period of time because the money has to be invested for that period of time to get you the most optimal or the best return. So from that point of view, you can't pull your money out until that period of time is over. And to follow up on your next question, can you roll over into a longer time frame? Yes. So let's say at the end of 5 years, when the properties are sold, now you have a capital gain tax, and you have a sort of your amount that you invested has increased a certain multiple fold. You can take that money and invest it into another private equity real estate fund with that same operator or another operator, or the same operator may have already floated another equity fund. You can do that and figure out what is the best way to save taxes, right? And they can even offer you, like we are going to offer our investors at the end of our life, what is the best way for them to get out of this. So yes, you can do that. You can keep rolling your money to create more, wealth without paying any tax, by tax saving and not paying taxes on it. So that's what real estate allows you. Whereas in stocks, the day you sell your stock, you have to pay the tax. You can't roll it into the next stock. So that's an advantage real estate has. I think we are at the, next question just came in. How long have you been in this business? Since 2018. Do you consider...
We've also invested in a 450 unit multi-family apartment complex in Huntsville, Alabama. So we also are owners of that, and other investors also invested in that along with us.
Yeah, so Homayar and I have experience in retail net lease as well as multifamily. Those are the two asset classes that we currently focus on. That's our forte. Do you consider refinancing during the whole period and remitting investor equity? Yes, absolutely. We consider that. And if it makes sense, once we know there is a little bit of an equity in the property, and if we feel like we can get that equity out for our investors, absolutely, we will do that. How transparent is your fund and what recourse do we have? Because we have been burned before investing in private equity funds. Please don't take this personally. Thank you. Oh, of course not, Zenobia. I will, no, nothing is personal here. You can ask any kinds of questions. So like I said, I mean, if you have any questions, you call us, we answer all your questions. There are, I mean, our current investors, some of our current investors are on this call, and you know, I don't know if any one of them wants to give a testimonial, but you know, we are very transparent. We share all the information with you guys, and you know, we also send out quarterly reports on how our fund or property is doing, so that way you have an information, and you know, we also provide regular distribution. So I mean, that's all I can say right now without saying. Giving you any more specifics, but we'll be happy to talk more.
Yeah, so I would add that usually you need to see if the fund managers, I mean, you might have invested in private equity funds, and we are sorry to hear that you know, we were burned before by doing so. But if you invest in funds where the managers like us also invest with you, that's very important to see, because if we have put our money and we sign on the loan guarantees and everything. So if we do that, we have some conviction in that property, in that fund. So you are also investing along with us, and we are not just using your money and investing and we are sitting on the sidelines. So you need to kind of evaluate where the fund managers' interests are. And you should invest in someone who you like and trust. And that's something that you have to take a call on. But these are the things you should really consider before investing. And it's a long-term commitment. It's not something you should never invest funds that you need immediately. You should invest funds that you have put aside for a long term and you don't mind putting it aside and they have the funds make money for you for the next 5 years, 7 years. So what's an average rate of return?
Yeah. There's also what recourse do we have? I mean, I said the recourse is, you know, I mean, if the fund goes down, your recourse, at least in our case, is only to the capital invested, right? I mean, you don't have any personal recourse on any loans or any other liabilities. So because you're a limited partner, your losses are limited to the capital invested. At least, you know, that's how it is with us. But again, we don't have anything like that. So, you know, we can talk more information, Zenobia, if you want to call us later.
What's the average rate of return on a fund invested for a bit? It entirely depends on the fund. It ranges from 10% all the way to 20%, depending on the risk that you are taking in the fund. Like if you're investing in high risk assets where, you know, they are flipping a property or something of that sort, the returns could be high, but there won't be any cash flow. You'll get more appreciation, you get less cash flow. So depending on the fund, people pay dividend on a monthly basis. Funds pay out dividend on a monthly or quarterly basis. It depends again on the fund. And that's the preferred return. So the preferred return is something that the limited partners get paid first before the managers even take anything for themselves. So that's a preferred return that you get paid on a monthly or quarterly basis. And plus the appreciation is at the time when we exit.
And I think this average, I mean, I think the numbers that Homayar took 10 to 20%, those are average annual returns, right? Yes. So if you're
net of fees.
Yeah, it depends on, again, different asset classes, right? I mean, if it's a value-added property, depending on the value add you do, your returns could be significantly higher. But if it's a core property or core plus, you know, already in an established location, you know, again, I think it's all about risk rewards, right? If it's a risky property, the rewards or returns could be higher. And if it's a low risk property, the rewards or returns are, average. So it really depends on each property. Okay, thank you. Have you
considered mobile home parks or storage units? Yes, we have considered. Hi.
I am so sorry to cut everybody off. This has been a really fruitful conversation, but Rustam uncle and Edul uncle believe that we should kind of cap it at an hour and a half. If anybody else has any other questions, why don't you guys put your information just one more time in the chat, and we'll leave it up for another minute or so while everyone's getting off. But I'm so sorry to end this. But it has been wonderful, and sorry, my son is here. He just woke up too. So he says hello to everybody.
Hello.
Hello.
So thank you everyone for joining us. We appreciate your time. I know it's Dansak time for many of you, and we don't want to put you back from your Dansak. So, if we'd be happy to talk to you. And Homayar has left, this link here. And if you guys have any questions, please
feel free.
And we'll be happy to answer all your questions. And again, I'm going to leave my number here again, and please call us and we'll be happy to answer all your questions. But thank you so much. We appreciate your time and presence here, and we look forward to speaking to all of you soon. Thank you so much.
Thank you very much.
Happy holidays.
Great opportunity.
Thank you.
Thank you.
Thank you.
Bye. Happy holidays.